All right, good afternoon. Thank you so much for having me. This is Joan Work with Paul Decaire, who is in the audience. So I'd like to start off this project and the paper by drawing a contrast with what we believe is the main task of the CEOs, which according to most textbooks would be to implement and select the highest NPV projects. And perhaps one of the main tensions in corporate governance that the agency theory postulates that CEOs do not always act in the best interest of the shareholders, and some of the projects offer private benefits to the CEO. We'll call these projects pet projects. These pet projects, so that tension is really at the heart of the corporate governance theory. This is the wedge that between the incentives of the shareholders and the incentives of the CEO. In particular, the shareholders would like the CEO to pick the highest NPV projects, but the primary reason why the CEO may not pick those projects is because some of the projects may be more appealing to the CEO personally than they are to the shareholders. Again, those projects that offer benefits to the CEO, whether pecuniary or non-pecuniary, we'll refer to as pet projects. So while these pet projects have played a central role in the theory of corporate governance, the empirical evidence on these projects has been very scarce. In particular, identifying such projects in the data is elusive because it requires several conditions that have to be met at the same time. So first of all, in order to be able to identify these projects, we'd like to observe the investment opportunity set. Most of the time it's unobservable for the firm. We want to identify the projects in the pool that offer private benefits to the CEO. We want to measure those private benefits to the CEO and eventually want to evaluate the ex post performance of such projects relative to their reasonable counterfactuals. Okay. So what this paper is going to be, it's going to be among the first studies to reveal the CEO's private monetary benefits in capital budgeting decisions and to study how these monetary benefits affect the selection of projects, their sequencing, and outcomes. We hope to accomplish this goal by offering an empirical setting in the oil and gas industry that yields several important benefits and allows us to overcome some of the challenges in prior work. So first of all, we're going to look at a very large pool of projects, so over 200,000 capital budgeting projects in oil and gas exploration that together account for approximately $1 trillion in capital expenditures. It's a very large number. That's about 10% of total CapEx in the United States. They are spread around geographically. They are very homogeneous and they're substantial in size. So the mean investment of a project is about $3.4 million, and the cash flows of such projects look like a cash flow from the textbook of a typical investment project, where you have an initial cash outflow at the beginning and then you have cash inflows for the rest of the project's life. Importantly, in year one, you will see that the cash flows will peak out. This is when the well is drilled and the pressure is the highest, and then they will gradually diminish as the well is gradually completed. So these projects have very predictable cash flows, which will allow us to evaluate their quality, even according to early cash flow data. Okay, so how do we identify PEP projects in this pool of homogeneous projects? We'll look at the CEO's private benefits that are dependent on the implementation of these projects. In particular, we will identify CEOs who own personal land assets on oil and gas fields, and such personal land assets will benefit from the exploration of oil and gas fields. So in other words, when a company or when an oil field enters an exploration stage, because the company starts drilling, usually you will see a large increase in the value of accruing to landowners in the form of the signing bonus, in the form of cash flow payments, and these benefits are very substantial. I'll give you a taste of those benefits, but to give you an idea, the mean property for a CEO is about $1 million, and the typical CEO in our setting has 1.7 properties. So these are substantial investments. Okay, so here's a summary of our main findings. we're going to, I'm going to break it down into three parts. First, the part on resource allocation. So we find that CEOs are about 3 times more likely to start drilling on a field where they have personal assets. And this relationship gets even stronger during periods of higher managerial slack. So during periods of high oil prices where managers are have more cash flow. So very reminiscent of Jensen's free cash flow problem, kind of tying it back to the origins of pet projects. Okay, once the project it's already underway, CEOs appear to invest more intensively into these pet projects. They invest about 7% more capex into the fields where they own assets. So to summarize, CEOs invest more into pet projects, both in the extensive margin, meaning project initiation, and the intensive margin, meaning the amount of investment after the field is being explored. Okay. So there could be at least a couple of main explanations for why the CEOs might be doing this. One is information. So they have superior information for for a particular field, and this is why they invest there personally, and this is why they invest the firm's assets. Or it could be an agency explanation where the CEOs invest for private benefits. To distinguish between those explanations, we'll look at the ex post performance of the projects, and we find that these projects underperform according to various capital budgeting criteria. It's a very broad result that holds according to NPV, IRR, initial project output, and with substantial magnitudes. Okay, so on average, CEO pet projects deliver about 12% lower initial output, 9% percentage points lower IRR. So why might that be happening? Well, the explanation that we have right now is that it appears that these projects introduce an idiosyncratic constraint on the drilling location. So instead of looking nationwide, firms are sort of more focused on drilling specifically where the CEO has personal assets, and the CEOs appear to be overinvested. So drilling a little bit more than what's necessary. So they step down the project quality and end up on average with the lower marginal quality of wells that are drilled. So we find evidence consistent with the agency explanation. And lastly, we'll look at sort of various governance mechanisms that attenuate or magnify this relationship. And we find that pet projects perform worse when the CEO has stronger control rights. So when the CEO is the primary decision maker, it's also the chairman of the board. So there's less curbing activity on the part of the board. And when the CEO faces weaker monitoring in terms of less concentrated ownership base and the absence of block holders. So roughly, this is the 3 main findings in the paper. And we show that these findings are robust to alternative hypotheses. So the 2 perhaps most prominent hypotheses that come to mind is one, selection. So CEOs somehow may select into these properties. And how do we distinguish selection from sort of the exogenous endowment of these properties? We'll look at those properties that are inherited, and particularly those properties that are inherited before the discovery of oil and gas deposits. So we would like to shut down the CEO's informational input and kind of exogenously endow the CEO with those properties. And we do so by looking at the properties acquired before the discovery of oil and gas deposits, and again, through family connections. We also address the local bias. So perhaps the CEO invests more in locally proximate locations, and we do so by using CEO times state fixed effects, which will capture any relationships that the CEO might have with a particular state, whether the CEO being born in that state, with the headquarters being in that state, or the CEO having gone to school in that state. Okay, so to summarize, this is the paper in a nutshell. We find that CEOs tend to invest more in projects that provide strong personal benefits to them. And this is one of the first links between the CEO's private assets and capital budgeting decisions. That's the paper. Let me stop here for a second and take the questions at this time.
All right. Okay, we have a few questions, so let's start with the first one. The CEOs may also have expertise in the area where they live or own property. Don't they disclose this conflict to the board and get prior approval?
To my knowledge, there's not a requirement that they disclose ownership of personal assets. So the way we went through this is not through the firm disclosure, but through official county records. And we have not found evidence that this information is disclosed to the shareholders.
Okay. Do CEOs own those land before they've been appointed as CEOs, or this is something they acquired in their position at the top of the company?
We have both, and we it's one of the robustness tests. We only focus on properties acquired prior to the CEO taking control of the firm's investment decisions, and the results hold in that subsample. So I think maybe around 55% of the properties were acquired prior to the CEO assuming the control rights of the firm, and all the results hold if you look at those properties breaking the simultaneity with the firm decisions.
Are the CEOs usually internally appointed, or these are brought from outside?
We have not made a distinction whether these are internal or external CEOs. In general, the breakdown between internal and external is about 70% internal, 30% external.
Okay. Land acquisition is a large part of an oil and gas project. Can it be that CEOs save the company money by offering, quote unquote, their own land assets, which otherwise would have been leased from other owners under less advantageous terms?
We have not found evidence that they are offering this land to the company for free. So we have looked at briefly at the contract in terms with the landowners, and I'll give you some of the evidence on these contract in terms. But what happens is that when the company starts exploring an oil and gas field, contract owners actually receive large monetary payoffs. The bonus payments go up, and royalty payments go up. So we have not found any evidence of such pro bono agreements between the firms and the company.
As is contiguous to other potential tracks, then the price will increase even without drilling. But if drill and get a dry well, that would hurt its value. So uncertainty has value. Is it optimal to wait under some parameters?
I'm not sure I fully understand sort of the optimality condition here. So maybe we could ask the participant to elaborate a little bit on that question.
Okay. All right. So let's move on then.
Okay. All right. So let's think about how we identify the properties. As we said, those are typically, to our knowledge at least, are not disclosed to the shareholders. We go through a multi-step process, which I'll explain in the next couple of slides. For now, let me give you a bird's eye view of how these properties look. So on the left-hand side, you see an aerial view of an oil and gas field. And those, the little squares are you could see the wells being drilled. On the right-hand side, you could see how a well it looks on an oil and gas field. So we'll go through a multi-step process to identify firms, projects, and fields. And we start with the firms and projects, and we obtain newly the universe of domestic oil and gas drilling. So this consists of both public and private firms. So we have about 300 firms, almost 60% public, about 40% private, quite geographically dispersed, 19 states, and we have very detailed data at the project level. So we have the timing, location, cash flows for each project, and by itself, so while we use this as a laboratory setting, by itself, these projects are very economically important. So the firms in our sample comprise about 8% of S&P 500. They support 10 million jobs, and as I'll say later, they account for about 10% of the entire nationwide capital expenditures. Okay, so this is to illustrate the importance of such firms. You could see, there's variation throughout our sample in their share in capex and S&P 500, which peaks around 2010, and the average throughout the sample is about 8% share in S&P and about 10% share in total annual capex. So an important sector for the economy. Okay. Now, for CEOs, we contain a lot of biographical data here. The most important piece of information we collect is information of real estate assets that were purchased or owned or inherited by the CEO. And we have the entire history of ownership of such assets by the CEO, and as well as the timestamps of when these properties were purchased and the value, the purchase value. Okay. So what type of properties are we looking at? We're getting this information from tax and deed records, and the data source that we have, LexisNexis Public Records, according to the data provider, has the universe of county records. We obtained 155 investment properties. These are investment properties, meaning that they are distinct from the CEO's primary residence, and these are primarily land investment properties where land is greater than 50% of the value. They are located directly on the field, so mean distance between a property and the nearest well is about 3 miles, and they are substantial investments. Let me remind you that the typical property, the mean property is $1 million in value for the CEO. Okay, so this is how these properties look. You see the original name of the owner. So here it's registered in the name of the CEO and his wife. You see the address of the property, and you see the type of the property. In this case, it's farmland, so vacant land. For typical assessment record, you will see the date of sale. So in this case, the property was purchased before those deposits were discovered in the area. And you see the breakdown between the total value of the property and the value of the land. So this is how we are able to distinguish properties that are mainly purchased for land investment, kind of open land. And we are able to see those properties that were purchased before the CEO took control of the company, or sometimes before the deposits were discovered. Okay. So our condition is that the land has to account for the majority of the properties, so that we know these are not rental properties, not rental houses, but vacant land. Okay, so altogether, what I want to say about the data is that we have nearly the universe of onshore drilling for US oil and gas companies. So this is an important economic sector that accounts for 10% of the nation's capital expenditures. And we have the entire history of inheritance, purchases, and sales for individual properties by the CEO. Okay, all right. So that's the summary of data. Let me show you a little bit of a visual how we identify those properties. What you have here in the top right corner of your screen is the aerial view of an oil and gas field, and the red dots are individual wells. The shape that you have highlighted in red and shaded in yellow is the CEO's personal property. And you see in this case, there are two properties that are drilled, two wells that are drilled on that property. Okay, so we identify this CEO's property and we reconstruct the history and ownership period of that property. And then finally, we compute the private pecuniary gains to the CEO. These gains are substantial. So we estimate that for each additional property that's drilled on the CEO's, for each additional well that's drilled on the CEO's property, the landowner gets approximately $100,000 in discounted cash flows. And the bonus point, and this is just the royalty payments, right? So an additional component beyond royalty payments is the increase in the sign-up bonus. So the sign-up bonus more than doubles at the time, at the start of the exploration. And these are, we would argue, these are substantial monetary incentives for the average CEO. So in this example, the CEO has 2 wells drilled on the property. So for 2 wells drilled per property, we estimate about $340,000 of an extra cash flow received at or as an incremental benefit to the initiation of exploration. If you were to compare this relative to the CEO's compensation, that's about 21% of current compensation, meaning current annual compensation comprised of salary and bonus. And if we refer to sort of other sources of personal enrichment for the CEO, such as insider trading, this is an order of magnitude greater than the typical insider trading gains that are usually on the order of $30,000, $40,000 a year. Okay, so a substantial increase in monetary compensation, roughly 20% of annual pay. Okay. All right, so let me stop here and take any questions you may have on the data and the setup, and then we'll go into the investment properties and entry.
Okay, we have a couple of clarification questions. So again, the question is, wouldn't be considered as a related party transactions? In that case, they're obligated to disclose.
So here they are not, again, they're not transacting with the CEO. So they're not, leasing the land back from the CO. They're simply entering an oil and gas field, and the CO indirectly benefits this from the exploration of an oil and gas field, right? So the company starts drilling in the vicinity, and the properties benefit simply because the deposits are now in the active exploration stage. The farm does not contract with the CO directly, does not lease the land from the CO directly.
Okay. Would the results hold if the private companies be dropped from the sample? Some of the private oil companies are actually family businesses.
Great question. And we do find a significant distinction between public and private farms, and all the results are pretty much driven by public farms. So we view this as evidence of greater separation between ownership and control. As you noted, for private companies, a lot of these are family owned or owner operated, where you do not have an agency conflict because the CEO is the owner of the company. What I think is important for us from a governance perspective is that when you flip on the switch of the separation of ownership and control, when the CEO is just an outside manager hired to manage the company, this is when we see the results take place exactly as the agency theory would predict. And the results are driven by public firms, not private.
Okay. How do you identify the date when the deposits are discovered?
How do we identify the date when the deposits of oil and gas are discovered? So one approach that we go after is the discovery of fracking. That was so that the fracking technology essentially was commercialized. The first mention of commercialization of that technology was in 2003. So this is a pretty pretty clear cutoff with respect to any deposits that were extracted using that technology not being commercially viable prior to this exploration. We also look at the first, nationwide. We'll look at the first timestamp of any company beginning in exploration stage, and that's sort of another cutoff that we use for looking at before the oil and gas discoveries.
Okay, here's another ownership question. So how do you deal with publicly trading on exchanges limited partnerships? What are the results for those firms?
Publicly traded ownership.
Limited partnerships.
Limited partnerships. I don't know if those are in our sample. I think our sample is publicly traded corporations as opposed to partnerships.
Okay, going back to the issue of legality and conflict of interest, does this behavior have legal issue? For example, do shareholders sue CEOs because of private benefits that they acquire in such transactions? Is there any potential legal recourse? Yes.
Remember that sort of from a legal perspective, you have to prove wrongful intent usually in cases of conflict of interest, and it would be very difficult to prove wrongful intent because the easiest comeback from the CEO would be, look, I put my own $1 million or $1.7 million if they own two properties into this land. How much more evidence do you want that this is the good investment? My own money is here at stake. So it would be very difficult to bring legal charges because you would have to prove that the CEO did this for personal enrichment rather than for the information hypothesis. We can do this quite rigorously with all the econometric techniques and multidimensional fixed effects, but this is this would be pretty difficult to prove in court. The second issue is that one thing that I'd like to mention for the audience is that a typical farm drills close to 100 wells per year. So this is if one or two wells are drilled adjacent to CO properties, This is a very small fraction of the firm's investment portfolio. So again, to summarize the response and the legality, one, this behavior is relatively difficult to identify and it's not consequential for firm value, right? Given it's a very small subset of projects. Two, it's very important for the CEO. It gives them significant monetary benefits, but it's difficult to prove wrongful intent versus the information intent in court, and that's usually the bar that the CEO would need to, to be accused of conflict of interest, of breaching fiduciary duty, of acting against the interest of the shareholder.
Okay, thank you.
All right, then we're gonna go ahead and look into our first set of results, which will focus on the firm's entry into oil and gas regions. This is the extensive margin. These firms beginning to drill in the oil and gas fields where the CEOs have private properties. Here you see the map of the drilling activity, and what I'd like to emphasize here that this is very well spread out across the United States. You have 19 states, anywhere from California on the west all the way to New York and Ohio, Pennsylvania on the East Coast, and then anywhere from southern Texas in the south all the way to Montana and North Dakota and Alaska in the north. So it has important, what we believe is that our findings have important implications for local economic activity, which is dependent on firms drilling. So the first main result is the decision to enter an oil field. The dependent variable here is an indicator where the CEO decides to, where the firm decides to enter an oil field. An oil field is going to be, and that's just an indicator dummy, one for the entry of an oil field in a given year. An oil field is a highly granular unit of measurement. It has a radius of about 33 miles, and we'll have about over 1,500 oil fields in our sample. So this is highly granular analyses. What we find here in our main baseline results is that a firm is about 3 percentage points or nearly 3 times as likely to enter a field where the CEO has an investment property, so a very large economic magnitude. And these are linear probability models, and that's kind of the interpretation of the coefficients. You see that the coefficient estimates are very stable in economic terms. So I believe that's important as you introduce various fixed effects for the firm, year, CEO, and we're trying to be very transparent in how we introduce those fixed effects to show that those magnitudes remain very similar and increase in 3 to 4 percentage points in the likelihood of entry. We also show the robustness of our findings using a hazard model that also tells us that the CEOs are more quick to enter such fields. So they're more likely to enter such fields, and when they do so, they enter more quickly. And here, let me direct your attention to some of the fixed effects that we introduce in these regressions because they show robustness to some of the important alternative explanations. So we have 3 high dimensional fixed effects in the specification where firm year fixed effects most importantly control for changes in the firm's investment opportunity set. So this would capture any variables that affect a given firm within a given year. You can think of the financial condition, annual investment budget. You could think of any sort of firm level variables that change from year to year and affect all projects. Okay, then we have field year fixed effects. These pick up the attractiveness of the oil field. So any changes in new discoveries, changes in regulation, taxation. So anything that affects how attractive that field is, for exploration, maybe new infrastructure developments, maybe new state laws, and so forth. And lastly, we have CEO times state fixed effects. So these will capture the characteristics of the CEO, him or herself, such as risk aversion, such as expertise, skill. You could think of overconfidence and so forth, as well as the relationships that exist between the CEO and a particular state. Maybe the CEO has an affinity for a given state because this is where he grew up. Maybe he has superior information about that state because he went to school there and so forth, right? Or because the headquarters is located there. So that controls for local bias. Okay, so the results are robust to those explanations, and some as well. There are some additional specifications that are in the paper. We First, we address the issue of local bias. We control for distance explicitly between the firm's headquarters and the oil field. And we do find that firms, all else equal, firms like to invest in geographically proximate fields, but our results hold controlling for that relationship, as well as controlling for the CEO state fixed effects, which will control for the relationship between the CEO and the state, as well as between the relationship of the headquarters and the state, so the investments that are happening in the state of the headquarters. We do a few tests to rule out reverse causality. So we replicate with inherited properties and replicate with properties that were acquired before oil deposits were discovered, and replicate with properties that were purchased before the CEO took control of the firm. So before he was appointed to the CEO position. And lastly, we look at the managerial slack to kind of as a first slice of governance, right? So the free cash flow, Jensen's traditional free cash flow problem would tell us that when managers have more free cash flow, more managerial slack, they're more likely to implement projects that benefit them personally at the expense of the shareholders. And we have, I think, a nice setting to get exogenous variation in free cash flow through oil prices. So when oil prices are high, let's say due to increased tensions in the Middle East, we find that CEOs are more likely to implement their free cash flow projects, perhaps due to greater managerial slack. Okay, so that's the set of the main results. And next, I'm going to show you those results in the instrumental variable. So again, as an additional way to break out the issues of simultaneity or reverse causality, we replicate the results with an instrument where we're instrumented for the location of the CEO's investment assets. Again, we're trying to find a factor that would exogenously endow the CEOs with investment assets that would be plausibly unrelated to the firm's investment opportunity set. Okay, so for that, as a candidate variable, we propose the location of CEO's relatives. So CEO might have a son or a daughter in a particular state, and we argue that the CEO would be all else equal more likely to purchase assets in that particular state because these assets are easier to maintain. They're lower acquisition costs, they're lower maintenance costs, but those costs are only specific to the CEO. And these assets are more likely to enter the consideration set. So we're going to look at the assets that are within a driving distance of the CEO's relatives that the CEO may discover while visiting his relatives on that trip. Okay, so let me help you visually illustrate this instrument. So we have here on the map is some states with oil and gas exploration. The firm is headquartered in Oklahoma, and you see the headquarters in the circle, and then the red circles are individual oil fields. Larger circles correspond to greater fields. Okay, so in this case, our CEO lives at the headquarters, near the headquarters in Oklahoma, and he's got his parents in Missouri, I believe, and he's got his daughter in Tennessee, and he's got his son in San Antonio, in the suburbs of San Antonio, Texas. Okay. So in this case, across these relatives, the CEO's son lives nearby an oil field, and that's going to be our treatment field. So this will mark this field as a treatment field where the instrument would take on the value of 1. Okay, and we will compare this treated field to a control field that is in the same state, has the same fundamentals, and we're going to compare them in the same year. So the relevance condition is that all else equal, we will argue that the CEO is going to be more likely to acquire a field within the driving distance of his relatives, rather than observationally similar field in the same state with similar fundamentals. Okay, and we indeed find that to be the case. CEOs are more likely to buy near relatives with very reliable T statistics greater than 3, F statistics exceeding the rule of thumb threshold of 10. And then from the perspective of the exclusion restriction, we argue that the distribution of the CEO's relatives across the states, and these are children, parents, in-laws, or is unrelated to the firm's opportunity set, except through the CEO's private benefits. And those private benefits could be monetary through through personal properties, or pecuniary or non-pecuniary, non-monetary, visiting parents or visiting his children. Okay, so overall, we find that the instrumented assets of the CEO increase the likelihood of firm investment, and I'm going to show you this in the on the slide. So here's the first stage in the top portion of the slide. You see the family connection reliably, positively connected to the CEO's decision to acquire properties. In economic terms, so CEOs are more, in this case, 2 percentage points more likely, but given that there are many fields, they're several times more likely to acquire properties next to a field where they have a relative. And then the second stage, you see again, the results hold robustly with a battery of fixed effects and all T statistics exceeding the minimum threshold of, all F statistics exceeding the minimum threshold of 10. So that is our way to additionally make a step towards making a causal statement that when the CEO's properties are, when the CEO gets properties through the location of the relatives, which are distributed across the nation, CEOs are more likely to invest next to those properties. Okay. All right. So before we go to the intensive margin and investment intensity, let me stop again and give you a chance to ask any other questions that you may have.
So the question that I have is, what about the likelihood of really bad outcome? Perhaps the CEOs drilling there, and again the performance is not as good on average, but at least the variance of the results is smaller in the case of these particular properties, particularly the chances of having a dry well.
So that would be kind of an idiosyncratic project risk, right? You would, I mean, according to the textbook, you would apply the weighted average cost of capital, and you would discount the projects at the weighted average cost of capital, from the shareholders' perspective. So that would be something that the CEO might do just out of whim, but would not be consistent with what we believe would be value maximization from a shareholder perspective. So that's kind of an argument, an analytical argument. In reality, we find that these projects, where these projects are more likely to be unprofitable. We'll show you that result when we get later. So they're not just performing worse, but they're more likely to be negative NPV. And we also find that they're less likely to be home runs. So there's less right tail for these projects. They're kind of more mediocre on average. And Andrei, let me know if you have a follow-up on this question of the addresses.
No, that's good. All right, let's move on then.
All right. So now the second set of results is the investment intensity. So now we have entered the oil field where the CEO has an investment property, and we're looking at how many wells are drilled in those oil fields. So here we're looking, the dependent variable is the investment rate. And we're finding that that CEOs invest more heavily in projects where they own private personal investments. So the investment rate increases about 7 percentage points for oil fields where the CEO has an investment property. I want to emphasize that these results hold after accounting for field quality. This is a very high bar because field quality is very difficult to capture. Right, field quality is unobservable, and what we're doing is we're looking at field times year fixed effects. So this would capture all quality variables or the evolution of field quality every year. The field is, new deposits are discovered, new regulations introduced, new infrastructure is being built, and we're capturing that all of those variables at the annual frequency that are relevant for that field. And our results hold after controlling for field quality. So we can say over and above the field quality, CEOs tend to invest about 7 percentage points more in the fields of their pet projects. Okay, and then here's the second result that I would like to emphasize, and this is the early sign or sort of early signal of the potential agency problem. when a company drills an oil well, it's pretty easy to see right away within the first year whether this was a successful or a less successful project, because the cash flows in the first year of those projects are the highest cash flows that you can achieve throughout the project's life. And the well quality is gradually depleted, and those cash flows gradually go down as the project matures. So we have a very clean estimate, and we have engineer models that we flesh out in the paper, but we have a pretty clean estimate of project quality early on. And we find that pet projects are become less sensitive to field quality, and the COs continue drilling in those projects even if the initial output is low. So in other words, this investment becomes, the marginal investment becomes less sensitive to the signs of project quality and the signs of sort of future free cash flows, right? So they keep drilling for the sake of drilling and less for the sake of field quality. Okay, so does this mean that CEOs overinvest in these projects? And that's what we're going to look at next when we look at performance. So far, we find that CEOs are more likely to enter a field where they have an investment, a pet project where they own land. We also find that they tend to drill more in that field, and the drilling is less responsive to early signs of project quality. So they tend to drill more irrespective of the early signals of project quality, which is reminiscent of the theme of overinvestment. I'm going to test this more clearly and looking at project performance when we go next. And again, before we go to the next,
stay on this slide just for a second.
Sure, so and I want you to stop here as well to give you a chance to ask any questions.
Okay, so point estimates of 6.41 and 6.82 are not that different without any fixed effects. How should we interpret this result? Does it imply field quality does not matter, which would be difficult to understand?
Well, you could see that the fixed effects are being gradually introduced here, and you see that, for example, firm fixed effects tend to have a lot of bite, and year fixed effects, CO fixed effects, field fixed effects being introduced. Well, to me, that this is, again, there's a variation in the point estimates. I view this as when we're comparing field fixed effects, for example, with firm and CO fixed effects, to me, the comparison of these estimates suggests that there is a common component. There are some firms that are more likely to drill in some fields, and COs in general, that drill in some areas. So to me, my reading of this is that the reason that the estimates don't change much, let's say with just field fixed effects and then field and firm fixed effects, is a view that some firms invest more in certain fields. But if you look at the introduction of field fixed effects relative to no fixed effects, you see a huge difference, right? So if you compare column 1 that has no fixed effects and then column 5 that has field fixed effects, there's a significant change in this estimate. So it does have bite, but I think there's correlation in the types of fields and that the firms tend to invest in. That's my reading. But again, please follow up if you'd like to elaborate on this.
All right, thank you.
Okay. Any other questions on the message board?
Not at the moment.
Okay, great. Then let's look at the project outcomes. So this is kind of to round out our analysis and to distinguish between the information story and the agency story. And again, the information story being that the CEO has private information. Could view different types of private information. These projects are more profitable. These projects have lower costs, or whatever that private information might be. Okay. So the benefit of our setting is that we have very good project level data that allows us to estimate cash flows at the individual well level. So we're going to go even more refined here. We're going to look at the well production, the production of a given well in terms of the cash flows in millions of dollars, right? So we know the production of well in barrels, and we're multiplying it by the prevailing oil and gas prices. We also know how much output is in oil and how much output is in gas. So that's going to be our dependent variable for the next couple of tests, the amount of cash inflows that the well generates. Okay, and again, as before, the CO's private investment is an indicator if a well is drilled on the CO's investment field, where the CO would benefit from the exploration of that particular field, even again without having to contract directly with the firm. To help you visualize the source of identification, let's turn to this aerial map. And here you could see the shape of oil fields, and this is why we usually use oil field as a unit of observation, since they often have irregular shapes. So you have field A and field B on different oil and gas formations. In this case, the CO has a private property, pet property on field B. When we do the estimation process, we'll tag all the wells drilled by the CO's personal farm, or the CO, the CO's farm in the field where the CO owns an investment property. We'll tag those as yellow wells. You could see those wells being drilled. And our control group will be the wells drilled by other firms, or the wells drilled by in other fields that are nearby. And I'll explain in a moment. So the CO's personal investments underperform according to a broad variety of benchmarks. So here they underperform according to the initial output. So they have about 12% lower initial output, or 400,000, nearly 400,000 lower initial output relative to other projects that are drilled in the same year, in the same township, and by the same CEO. Yeah. Okay. So let me elaborate on these fixed effects. So the firm times year fixed effects will compare the projects of this, the performance of these projects to the performance of other projects that are implemented by the same firm in the same year. So any kind of firm level factors such as capital budget and investment opportunities and so forth would be factored in here. And they also include township year fixed effects. In this case, we will compare the performance of these projects to the projects that are being drilled by other firms in the same township in the same year. This is a very refined unit of observation. I'll show you graphically on the next slide that townships are pretty small squares, around 36 square miles. Okay. So this is the sort of sources of identification with these high dimensional fixed effects. We're looking at, with the firm year fixed effects, we're going to compare the treated wells that are drilled by our firms in a given year with any other wells that are drilled by the same firm in the same year. So again, the firm year, we're fixing the firm within a given year, and we're looking at the performance of the projects drilled in the CO's field relative to the projects drilled on other fields. The CO's field here is tagged in yellow, and the wells that are drilled by the firm, the same firm and the same CO in a different field are tagged by purple. Okay. So here, controlling for investment opportunities, capital budget, and CO's incentives. Okay. Now, if we turn into the township year fixed effects, we're going to absorb a different source of identification. We're going to compare projects that are drilled in the same township in the same year, but different firms. So here our CO has an incentive to drill in that same township, but other firms whose COs don't own investment properties don't have such an incentive. So we're going to look at how we're going to compare the wells that are drilled by the firm whose CEO owns an investment property. So they're going to be yellow wells relative to the performance of wells drilled by other firms whose COs don't own investment properties. But again, they're in a very small geographic region here. So these are green wells. Okay, so there we're going to control for a variety of geological characteristics of the field, oil to gas ratio, deposits, ease of recovery, and their dynamic changes. Because when we're looking at township year fixed effects, we will look at anything that changes, any township characteristics that change given the year, including regulation, taxation, infrastructure, and so forth. Okay. So when we look at project performance, the results hold robustly with these high dimensional fixed effects, and we obtain similar outcomes using other metrics of project performance beyond wells production output. We're going to show you NPV, IRR, and fraction of unprofitable projects in a couple of next slides. Okay, so what do we, kind of to summarize, what do we see happening so far? We see CEOs investing more in properties, in fields where they own an investment property. And as a likely outcome of such an overinvestment, we see that the marginal wells that the CEOs are drilling tend to be of lower quality. This is kind of what you would expect if under the assumption that if you put additional constraints on the firm's decisions, these constrained outcomes are going to be inferior to unconstrained outcomes. So if the CEO wants to invest in particular regions as opposed to looking nationwide, these outcomes are likely to be worse. And the CEO invests more, all else equal, the marginal project is going to be of worse quality because the CEO is sort of in diminishing the marginal returns to capital. Okay. From the government's perspective, we also find that these outcomes deteriorate when the CEO has stronger control rights. So when the CEO has more decision power over these projects. And we're going to show you that when we look at the additional project outcomes and governance characteristics. So this would be a good place for me again to stop and take more questions.
Okay, so I'm going to probably combine some of the questions together. So it's only CEOs who are taking advantage of these opportunities to, help their private investments, or other directors are also doing the same? Could it be also a useful measure of firm's culture that is expected behavior for executives above a particular rank?
Yes, this is the benefits that we document to the management are kind of the lower bound, right? So we document only the benefits to the CEO. We don't document the benefits that might accrue to the CEO's neighbors, the CEO's friends, the CEO's colleagues, the directors, right? So in other words, the monetary benefits that we're providing here are likely a lower bound of those estimates. There could be additional benefits of other players, but in order for us to rigorously establish such outcomes, we need to collect all of the same data on the CEO's colleagues, directors, neighbors, or any other managers. And that's quite a labor-intensive project, to collect all of their properties. So that's why we focus on the CEOs as the main decision makers in investment decisions. So if we look at the prior literature by, this surveys by Campbell and Harvey, we'll usually find that the CEO is the main decision maker in such projects, that the investment decisions are pretty heavily centralized. This is why we focus on CEOs.
Okay, so do these results mean that CEOs fields produce about $600,000 less in profits? Could you use a scale-dependent variable rather than variable in $1 million to have kind of better comparison across the projects?
Yes, we could, and what we'll show you next will be NPV, IRR, which I think is as close as it gets to comparing the cash inflows and the cash outflows. This is definitely a valid point. This is just a first result, kind of to give you a taste of it, and then we'll go into project level data where, of course, the cash inflows will be scaled relative to the cost of the project.
Okay. Can the market distinguish between these projects and other projects in terms of mineral rights or royalty rates? Your story seems to be that there aren't the average projects, but those that are likely to be less productive, right?
Well, I think our story is that the CEO enters an oil field where he's got a personal property, and he decides to drill excessively in that field. And because of the excessive drilling, and the incentive for excessive drilling is that the more you drill and the closer you drill to your own properties, the more the higher the increase in property values and royalty rates. And we document this in the paper that the intensity of drilling is increases the royalty rates and increases sign-up bonuses. So our story is more of a story of constrained investment and overinvestment. So if there are 1,500 oil fields in the nation, you're just constraining your opportunity set to maybe 10, 15 fields, and which are not going to be the most optimal. And the second contributing factor is that CO is just overinvesting in those fields. So it's not necessarily that they're inferior, but it's that the CO is over drilling in them, which results in the stepping down of the marginal project.
Okay, can you link your results to any other behavioral biases, for example, overconfidence, that overconfidence in CEOs making more M&As, or overconfidence about the quality of their own personal projects?
We could interact it with the overconfidence measures of that have been developed in the literature, Malmendier and Tate, for example. For our purposes, we're most interested in the CEO's private benefits as opposed to sort of other behavioral factors why the CEOs might be doing this. But this is something that we could try in interaction effects. So I'll show you some of the interaction effects with governance measures, because we're trying to stay as close as possible to theory, which is the predictions of agency theory and sort of the factors that have been identified in the agency theory, such as managerial slack or the intensity of monitoring. And overconfidence would be a little bit out of scope for those models. So that's what's given us the direction, I guess. That's what we're staying with it.
All right, there's some additional comments in the queue, but I guess we probably need to move on with the time remaining. Okay. So let's move on, and again, if there's going to be time at the end, we're going to ask those questions. Thank you.
Excellent. So now let me show you the different performance metrics. So I'll start with the IRR. So in this case, we're looking at project performance where the dependent variable is the project's IRR in percentage points. So you could see here with the full set of fixed effects, projects deliver 9 percentage point lower IRR. We do the same analysis for NPV, and our point estimate is that pet projects deliver about 500,000 less in NPV, or about 30% less in NPV. And ultimately, the question is, does this lead the CEO to take on some negative NPV projects? And our answer is yes. So in this case, we're looking at unprofitable projects, and we document, we label the measure unprofitable as a binary indicator that's equal to 1 if the project's undiscounted cash flows, undiscounted cash inflows are smaller than the drilling costs. So this is a conservative measure, and this will identify clearly negative NPV projects irrespective of any positive discount rate or any positive cost of capital that the CEO might apply, or the company might apply. Which is why we like it, because it's sort of less dependent on the assumptions. We're just comparing nominal cash inflows and nominal cash outflows, and we'll label a project unprofitable is if cash inflows don't cover the initial cost of the project. And we find that CEOs are about 4 percentage points more likely to implement unprofitable projects, or in other words, the pet projects are 4 percentage points more likely to be unprofitable, which is consistent with excessive drilling, where you drill more wells than maybe is optimal, and you ultimately get to some of the dry wells, which are negative NPV projects. Okay, so to summarize, these projects underperform across a variety of benchmarks. I've shown you initial output, internal rate of return, and net present value. And as a result of underperformance, the CEO takes at least some unprofitable or negative NPV projects. The fraction of value reducing project goes up as a result of this behavior. All right, and the final set of outcomes I'm going to discuss will be about governance and project performance. This is where we're going to loosen our identification a little bit, and we're not going to be attempting to provide causal inferences or as sharp of inferences. We're simply going to be documenting some directional associations, mediated effects, and the goal here is not to imply any causality, but rather to indicate under which conditions the behavior, the self-serving behavior of CEOs or in the investments in pet projects becomes more intense or more attenuated, right? Then we're guided by corporate governance theory, and we're focusing on control rights and the monitoring capability of the shareholders and the board. Okay. So first, we're going to look at the separation of the CEO and chairman roles. And the reason we like this variable is that a lot of companies have this sort of a relatively time persistent variable, that some companies always separate chairman and CEOs, and other companies kind of tend to keep them together. So this is sort of more of a company level governance or company level culture variable. And what we find is that pet projects, when we interact the CEO personal investment with CEO being or not being a chair in the project outcome regressions, we find that project outcomes get worse when the CEO has stronger control rights, when the CEO is board chair, and project performance gets better when the CEO has a chair of the board that monitors his activity. So that would be consistent with the importance of control rights highlighted in these theories of pet projects. And lastly, we also, as I advertised earlier on, we make a distinction between private and public firms, and we find that the results are almost entirely driven by public firms. So where the separation of ownership and control is more stark, and where the CEO is an external manager that's acting on behalf of the shareholders, exactly as the theory would predict, where there's a starker separation of ownership and control that precisely gives rise to the agency problem. Something that we have in the works is looking specifically at a subset of private firms that are owner managed. So the smaller subset of private firms where the CEO is also likely to be the main shareholder of the firm. We're hoping to have those results in the next revision, but so far it seems like the results are mainly happening in the cases where we have the separation of ownership and control in the traditional public companies. Okay, so with that, let me go ahead and conclude and take additional questions. We find that CEOs pecuniary benefits affect project choice, sequencing, and execution, both on the extensive margin, meaning in entering oil fields, and intensive margin, meaning the intensity of investment. Such projects tend to underperform, and the tendency to invest in these projects is higher for CEOs that have stronger control rights and have more managerial slack. Okay. Overall, we conclude we provide novel evidence on the distortionary effects of CEOs' private assets and document their important role in resource allocation. We believe that this is one of the first papers that provides large-scale evidence on pet projects. So pet projects are heavily talked about in the theory literature, but we don't believe there's been much project-level evidence on identifying those projects cleanly in the data and being able to trace such projects' performance. And if you guys know of any such evidence, please bring it up, and we would love to hear your thoughts. So let me stop here and open the floor to questions.
All right.